Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending June 30th, 2023. Looking at the market indexes for the week, the TSX, S&P 500, Nasdaq, Dow Jones, and Russell 2000 were all up for the week. Gold was also up, and oil made it up over $70 per barrel for the week. Canada did well because of a consumer price index inflation report, which was lower than expected. And we had a 0.4% GDP growth for May, with less interest rate hikes expected as a result, and a positively growing economy. So, looking at Canada, we got that great inflation report on Tuesday for the month of May. Our headline inflation dropped to 3.4%, a full percentage point lower than the previous month, mostly because of gas prices falling 18.3% compared to last year. The core inflation, which strips out food and energy prices, was higher than the headline inflation at 3.7%, but this was better than expected. The Canadian stock markets loved it. Now, we did have a report on Canadian business insolvencies. Those rose 39.3% year over year in May as government pandemic support dropped off. Compared to pre pandemic business insolvencies, the numbers are fairly stable. Insolvencies were very low during COVID due to that government support. Preliminary data suggests the gross domestic product in Canada expanded 0.4% in May, Statistics Canada reported Friday in Ottawa, led by higher manufacturing, wholesale trade, and real estate. That followed a flat reading in the previous month, missing expectations for a 0.2% increase in a Bloomberg survey of economists, in part due to federal workers' strike. March growth was revised upward to 0.1%. The economy is now on track to expand at a 1.4% annualized rate in the second quarter if June output is even flat. That's faster than the 0.8% pace expected by economists in a Bloomberg survey and the Bank of Canada's forecast of 1%. With a positive growth in the economy and retreating inflation, the markets loved Friday too. So on Friday, we also had a Bank of Canada second quarter 2023 business outlook survey and the Business Leaders Pulse survey from April through June 2023, showing that firms continue to anticipate weak sales growth ahead. Nevertheless, businesses reported that their indicators of domestic demand have moved up compared with a year ago as uncertainty about the path of future interest rates and concerns of a recession fade. Although firms' price setting behavior is gradually shifting closer to what it was before the pandemic, businesses continue to expect wage and price increases to be larger than normal. We also had the Canada survey of consumer expectations for the second quarter of 2023, and homeowners who are planning to renew their mortgages over the next 2 years and who expect a significant hike in their mortgage payments are likely to plan spending cuts. In contrast, many low income households are already buying only necessities, leaving little room for further cuts to their spending. Workers remain confident about their own employment situations, however. The perceived likelihood of losing a job has fallen back to pre pandemic levels. In addition, some workers report that their workloads are heavier than this time last year. Expectations for wage growth remain near survey highs. The next Bank of Canada meeting is July 12th, and with the great inflation read and the economy still growing, I am thinking they will return to staying pat. Looking at our friends south of the border, for the second quarter's markets, the S&P 500 rose 8.3%, on track for a third straight quarter of gains and its biggest quarterly advance since the fourth quarter of 2021. The Nasdaq jumped 12.8% for back-to-back positive quarters. The Dow added 3.4% for a third winning quarter in a row. The 23 biggest banks in the US passed the Federal Reserve's annual stress test, although results varied across the board. This year, the banks faced a, quote, severe global recession, end quote, scenario that included a jump to 10% unemployment and a 38% decline in housing prices. The stress test came as the banking sector contends with the fallout from March's regional bank failures, including potential for tighter regulation. Quote, we should remain humble about how risks can arise and continue our work to ensure that banks are resilient to a range of economic scenarios, market shocks, and other stresses, end quote, said Michael Barr, the Fed's vice chair for supervision. The U.S. initial jobless claims came in lower than expected on Thursday at 239,000. The 4-week average is 257,000, higher than expected. Continuing jobless claims were at 1,742,000, lower than expected. This is overall a positive in the U.S. economy, suggesting that the labor market remains resilient. The continued strength in the economy has given the Fed a free hand to keep increasing interest rates without causing a recession. Economic growth has been good, and there's optimism that if the economy were to stumble, the Fed now has the ammunition to respond. And an interesting piece from Florida. Florida is making it illegal for some foreigners to buy real estate near critical infrastructure. Foreigners from a designated 7 countries, China, Cuba, Iran, North Korea, Russia, Syria, and Venezuela, can only purchase a single piece of Florida land or a residence up to 2 acres as long as it's beyond a 10-mile radius of critical infrastructure or military sites. While this doesn't affect Canadians directly, keep in mind that the US governments can do anything they want, and foreigners are an easy target since they don't vote. As a foreign investor, I am always curious what fresh new difficulty, money grab, or problem one of the levels of US governments will create next. The only thing that's stopping them is that they like foreign investor money, but they could pile on taxes to make us lose all of our profits, just as an example. Microsoft aims to more than double its revenue by fiscal year 2030, specifically targeting 500 billion. CEO Satya Nadella laid out that goal in a memo last year that came to light Monday during a court hearing over Microsoft's nearly 70 billion deal to buy video game giant Activision Blizzard. It was a rare glimpse into the tech giant's long-term goals. Nadella also described a plan to return money to shareholders through dividends and buybacks. Quote, we believe this ambition and approach will help us deliver in excess of 10% annual returns to our shareholders over that time frame, end quote, the CEO wrote in the document, which was dated little over a year ago. On Wednesday, Nvidia Corporation slid over 4% in the pre-market trading after Wall Street Journal reported that Washington is considering new restrictions on exports of artificial intelligence chips to China. Advanced Micro Devices fell more than 3% in pre-market trading in sympathy. Lordstown Motors, the electric vehicle startup, created as the result of national and local political pressure during the Trump administration, filed for bankruptcy protection early Tuesday morning. Lordstown, which makes the Endurance pickup at its Ohio factory, also put itself up for sale. This is why I don't recommend investing in companies that aren't profitable. For every Tesla, there's many Lordstowns. The US GDP growth for Q1, quarter over quarter annualized, was 2%, higher than expected. Still nowhere near a recession. Some of you may be wondering how the US economy has been able to fend off a recession so far. The answer is that there exists an extraordinary excess demand for labor in the US. As of the end of April, there were 10.1 million job openings in the United States. While that is down from a peak of 12 million in March of 2022, it is still far above its pre-pandemic peak of 7.2 million in January 2020. If, going forward, job openings continue to fall at the same pace as over the past 13 months, it would take another 20 months or until the end of 2024 to fall below that old peak. This has allowed hiring to stay much stronger than would normally be the case given slowing economic growth. While initial unemployment claims have risen in recent weeks, continuing claims have remained at historically low levels as laid off workers have been quickly able to find alternative employment. And even in the face of rising layoffs and sluggish real GDP growth, payroll employment rose at an average pace of 283,000 jobs per month over the last 3 months. This is strong jobs growth feeding through to rising personal income has provided the economy with a degree of protection from recession and could continue to do so into 2024. If there is a slowdown in the economy with no one losing their job or not being able to work, they will be able to pay their mortgage, pay the higher prices, and never feel the slowdown. During his appearance in the European Central Bank Forum in Portugal, Federal Reserve Chair Jerome Powell expressed his belief that further policy tightening was imminent and hinted that the central bank would remain open to 2 consecutive interest rate hikes in the upcoming meetings. Mr. Powell also acknowledged the significant possibility of a recession in the United States, although he clarified that it is not the most probable outcome. Quote, the concern is about Powell's comments that we're just not done with rate hike cycles, that inflation is still too strong. The market has to accept that the Fed is not done hiking rates, end quote, said Phil Blancato, CEO of Landenberg Asset Management. Turning to some bits and pieces, according to the International Energy Agency, growth in world oil demand is set to lose momentum between now and 2028 period as the energy transition gathers pace. Continued increases in demand for petrochemicals are expected to be offset by weakening oil use for road transport. These estimates are very, very optimistic in my mind. These would be huge drops, which seems unlikely just looking at the chart. Finally, looking at next week, we have the end of the earnings recession for Q1. So just on Friday, we have the Canadian retailer Aritzia. Economic events next week, well, because of the holiday shortened week in the US and Canada, it's a thin week for announcements. Thursday, we have the US initial jobless claims and oil inventories. Friday is US payrolls and Canadian unemployment data, which is important for the Canadian economy. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out to any of these social media channels, and may you have a profitable day.